We're going to take the next few minutes and revisit our inflation roll-down scenario that we started in May. So welcome. First, before we get into it, let's just update to where we are in the capital markets. This is at the end of October. You can see that U.S. equities are down 18%, NASDAQ's down 30, the FANG stocks 40, international stocks, it's pretty ugly. Investment grade bonds down 15%. High yield bonds, gold down 11%, go figure. Inflation's running at 8-9% and gold's down. And commodities are up, macro funds, the dollar is up 16-17% for the year versus other currencies, and the famous Bitcoin is down 56%. So we've had quite a year so far. This year, the bond market, U.S. bond market, is the worst on record 100 years performance. So it's really tough. Interest rates have went up one of the fastest they ever have in a 100-year period. So it's been quite a year. So let's go back and look back in May. This was in May of 22. We came out with our inflation roll-down scenario, and we had some 7 or 8, 9 points that we said, here's what's probably going to happen. So let's go back and revisit this. Consumer spending was slowing. It is. Wage increases are slowing. House purchases slowing. Commodity price increases slowing. Money supply growth is reversing, actually be negative. It has. New bank credit slowing. Federal government spending is significantly slowing. The U.S. dollar has had a significant increase against the other major currencies of the world, and supply chains are slowly healing. So this is back in May. We said if the Federal Reserve does this, here's probably what's going to happen. 6 months later, all 9 points are right on target. It's pretty amazing what's happening. The world's central banks, as you read and you see the media almost every day, is inflation fighting, raising interest rates, extracting the money supply, pulling it back out, and attempting to defend their own currency against the U.S. dollar. Significant monetary involvement by all the central banks of all the major economies around the world. Yesterday, on the 2nd of November, the U.S. Federal Reserve raised the federal funds rate at 75 basis points, that's 0.75% to 4%. Fed Chairman Jerome Powell, quote, "We still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected, setting expectations of going to 4.75 to 5% as a possible terminal rate." So this has major dislocation implications in the financial markets when you raise interest rates this fast and this high. And here's a chart. If you go back, this was just January 1, right there. Interest rates were almost zero. This is the 1-year United States Treasury bill. Almost zero, 0.25% when we started. Today, 4.75%. Actually, as I walked into the studio here to record, is 4.8%. That's a major switch change. And so again, these things causes stock prices, private equity, real estate, everything to reprice, bonds, just pretty significant. Well, what is money supply? Why do we talk about money supply and the Federal Reserve? So let's visit that for a minute. Money supply is the fuel of the economy. Just like oxygen is the life to the grill. If you're grilling out and you shut the vents off, what happens to your fire? Well, eventually it goes out, right? So what's happening is the Federal Reserve is messing with the fuel of the economy. They are changing the price of money, which is changing the price of fuel. They're raising the cost of money. And at the same time, they're extracting the supply. Remember back in 2021 and 2020, how much new supply of money they supplied. So the Federal Reserve is in charge of pricing the cost of the fuel and the amount of fuel that's given to the economy. And a bigger picture, this goes back 60 years of money supply. And money supply simply means the amount of money that is supplied to the economy. And if you go back 60 years, the average increase per year of the supply of money is about 6%. The average economy grows at 6% nominal per year. So if you're going to grow, you need fuel, right? So if the economy grows at 6%, you need about 6% new money. That makes sense. And it's very volatile over time. And you can see here in 2020, 2021, massive increases in money supply. It's been all over the news. Everybody knows this. But what I wanted to point out to you, look at the amount of times that it's below zero. Not very often, right? Because you can't grow without fuel. And so here is we've got restrictive monetary supply. They're actually pulling money out. Money supply growth today is negative 7.5% annualized. So when you start taking out liquidity of the market doesn't like that. The market gets choked. The market can't grow. The economy can't grow. And that's exactly what the Federal Reserve is trying to do. Raise rates, slow the economy, slow the demand so they can get inflation control. The Federal Reserve cannot control the supply chain. They can only control the demand side of the world. So that's what they're focused on. So where do we go from here? Here's what we think the risks are. Big risk here is that the Federal Reserve may stay too tough, too long, too high. The downward momentum on the inflation, once it starts going down, and the leading indicator suggests that it is rolling down, can they stop it at 2%? Who's to say that falling knife won't keep going? So that's a big risk. And the dollar is very strong, putting pressure. And you got Putin, of course, and then you got corporate profit. So there's some risk out there for sure left. But there's a lot of positives. We believe the capital markets have already priced in a lot of the bad news. Corporate profits are likely to start to going down some, but yet maybe not too bad. Midterm elections are a positive because the third year of the fourth presidential cycle is very positive. Inflation declining, relative consumer spending. Residential housing, there's a real demand there. There's not going to be a crash. Will it slow? Yes. Has it slowed? Yes. But there's no crash coming. And the supply chain really caused the inflation, not demand. So as the supply chain continues to heal around the world, we'll get a little bit better. And of course, we got massive amounts of technology coming that's going to really help offset costs. So there are things to be positive about. The markets are leading indicators. In other words, the stock market tells you what's going to happen in the future, 9 months to 12 months. It is not a lagging indicator. CPI, when it's released every month, is lagging. Unemployment numbers, lagging. They tell you what happened yesterday, not what's going to happen. And so consumer confidence, another point, the consumer confidence and investor sentiment is pretty bullish, meaning everybody's so pessimistic that the odds of something else is going to happen are pretty good. And this just measures that. It's the opposite of on 2000, we had the highest enthusiasm we've ever had in 50 some years, and everyone remembers what happened in 2000. Well, the opposite here, we've had the lowest pessimism in 52 years. And in that time, when these points are this low, 12 months later, the markets are up 25%. So go figure. When people feel so strongly one way, things seem to happen the other. And lastly, I mentioned the presidential cycle. You can see here when the mid-year, which is now down 15%, the following year is up 16%. So all in all, there is some hope. It's not all bleak. We're pricing in a lot of things. Just be patient as we work through these things, and we'll keep communicating to you. So thanks for tuning in, and see you soon.